Raise your FICO score instantly with Experian Boost. Experian can help raise your FICO score based on bill payment like your phone, utilities and popular streaming services. Results may vary. See site for more details. Get started. Amounts owed 30%. A recent credit score survey by the Consumer Federation of America and VantageScore Solutions revealed a troubling statistic. A little over one-third of survey participants didn't know that maintaining a low credit card balance was good for their credit score. If you have credit cards, keeping a low balance to limit ratio, aka credit utilization ratio, might help you earn and keep a better credit score. Credit utilization is largely responsible for 30% of your FICO score. Aside from credit utilization, a scoring model may consider the following questions when it evaluates the amounts owed category of your credit report. What's the total amount of debt on the credit report? How does the debt break down among different types of accounts, e.g., credit cards, mortgages, auto loans, student loans, etc.? What's the total number of accounts with balances? Paying down your credit card balances is always wise, potentially good for both your credit score and your bank account. Yet as long as you're on time with your large installment loans like mortgages, auto loans and student loans, the balances on these accounts probably won't have much impact on your credit score. Length of credit history, 15%. The third most influential category of information when it comes to your credit score is length of credit history. FICO won't consider your age when it calculates your credit score, but the age of your accounts is fair game. FICO scoring models will ask the following questions when it considers your age of credit. What are the ages of the newest and oldest accounts on the credit report? What's the average age of all the accounts combined? How long has each individual account been open? When was each account last active? Time is your friend in this credit report category. Older accounts and an older average age of accounts may help you to earn more points for your overall credit score. Many people simply have to wait for time to do its magic when it comes to their length of credit history. However, if you have a loved one with an older, well-managed credit card account, you might be able to speed up the process. If someone you know is willing to add you as an authorized user to an existing credit card, the account might show up on your credit reports. Assuming the account is older, with no late payments and low credit utilization, it could help lengthen your average age of credit and potentially give your credit score a boost. New credit, 10%. Have you heard that checking your credit report might hurt your credit score? That's true, but only sometimes. 10% of your FICO score comes from the new credit category of your credit report. One of the factors considered in this category is how many recent inquiries, aka credit checks, show up on your report. When you apply for new credit, and a lender checks a copy of your credit report, this is known as a hard inquiry. Hard inquiries appear on your credit report for 24 months. Some hard inquiries may hurt your credit score for up to 12 months, but others may be ignored. Soft inquiries may show up on your credit too, but only on reports you check yourself. A soft inquiry usually happens when you check your own credit or when a lender targets you for a pre-approved offer of credit. Soft inquiries never impact your credit score. In addition to reviewing inquiries on your report, a scoring model may also ask: how many new accounts appear on the credit report? What's the open date of those new accounts, if any are present? It's best to make a habit of only applying for and opening new credit when you need it. Yet if you don't go overboard, you shouldn't be afraid to leverage your good credit rating to take advantage of an attractive offer. Credit mix, 10%. The final category that makes up your credit score has to do with the types of accounts that show up on your credit report. Diversity will help you here. Having experience managing a variety of accounts can be an asset, albeit a small one, to your credit score. A scoring model may ask whether the following types of accounts show up on your report: credit cards, installment loans, retail accounts, mortgage loans, finance company accounts. A variety of different account types may be good for your credit score. If your credit report has no revolving accounts, opening a new credit card and managing it well could potentially benefit you in the long run. Likewise, a credit builder loan might also be helpful if you have zero installment accounts on your report, but this isn't usually the best way to build your credit due to the cost. A credit builder loan has the unique ability to help you build a small savings fund while establishing a positive trade line on your credit reports, assuming the lender reports to the credit bureaus. You get access to the loan funds once you make your final payment. Credit builder loans aren't free. Be sure you're comfortable with the cost, interest and fees, and that have room for it in your budget before you apply. If you already have other positive installment accounts on your credit report, this type of loan might not benefit you as much as you hope. Finally, consider spreading out new credit applications rather than opening several accounts at once. You should also avoid taking on new debt for the sole purpose of improving your credit mix. Report trumps score. Despite what many people believe, you don't have just one credit score. You don't have only 3 credit scores either, one from each credit bureau. Rather, there are thousands of credit scores available. Imagine the following scenario. You apply for an auto loan, and the lender checks your Experian credit report and score. The same day, you pull your credit score online, based on your Experian report. Finally, you apply for a credit card where the card issuer checks an Experian-based credit score as part of the application. Trying to keep up with even dozens of credit scores would be a tedious task. Yet now you know where all these credit scores come from, the information on your 3 credit reports. You can and should review your 3 reports often. When you check your reports, pay special attention to the information that matters, like your payment history and credit utilization. And remember, if you find mistakes in your reports, you can dispute them.